this section, I want to talk about smart companies. Now, they are the new kids on the block. These are evolution of limited companies. Now, limited companies really exploded in 2016. We had the Finance Act. Section 24 of the Finance Act 2015 came into being, and that really opened the doors for us landlords because of the issues and challenges in how much you could claim in terms of interest when you own properties in your personal name. So limited company was a way of sidestepping that penalty, as it were, in terms of the limited amount of interest you could claim when you were a personal, when you own properties in your personal name. So own the properties in the limited company name, the shackles are off. There is no Section 24, and you can claim 100% of the mortgage interest. You all know that. So that was 2016. And if we fast forward to today, in our company, I would say 1 in 2, 50% of all purchase applications are now done within a limited company. So they've really now been embedded within the landlord psyche. They understand that, the landlords, they get whether it's right for them. And as I said, most landlords have a limited company and are certainly using them for their purchases. So before we talk about smart companies, I really want to just talk about a bridge, really, between the original SPV and smart companies. We've got SPVs with alphabet shares, and I want to talk about that because then that leads into smart companies. So best way to describe this, if you've not heard of alphabet shares, and if you've not, but you have got a limited company, then you should be taking some notes down because this could be really important for you, really useful tax mitigation strategy that allows you to get more of your profit out of the company. Because these alphabet shares, let's start off with the very basic. You've got Mr. and Mrs. are joint owners of the company. They are joint shareholders. They have 1 share each. And these are called ordinary shares, and they are A shares. And that allows Mr. and Mrs. to control the company and vote on the direction of the company, the strategy of the company. Sounds very formal. It's probably done over the tea table, but from a legal point of view, that's the shareholders coming together for a meeting and making a decision about the direction or strategy, as I said, of that company. You can only do that if you own an ordinary A share. Now, so why would there be a new category of share, which would be called a B share issued? Because, as I said earlier, the Mr. and Mrs. might want to issue this new category of B or C or D share to perhaps family members, or perhaps where it has also been used in trading companies to give to maybe key members of staff, senior management. And that, as I said, allows the ordinary shareholder, the A shareholder, to issue dividends to other people other than themselves. So if they want to issue dividends and reward family members or reward senior employees, but you don't want to issue A shares because all of a sudden they become an owner of the company and they can partly control the company and they can vote on the future direction of the company. You may not want your kids to do that. You may not want your employees to do that, obviously. So you need to introduce a different category of share that doesn't have those rights, those controls, etc., but it does allow the dividends to be issued. So if you've never come across those, that is a really a tax efficient way of getting money, getting profit out of the company through a dividends issue, but to those different category of shareholder. So that leads me nicely then into smart companies. So usually a smart company will have these alphabet shares within them, but it takes it now a step further. So the new category of share that a smart company has are called growth shares. And the real reason these growth shares are there ultimately is to avoid inheritance tax. That's So let me explain. So let's go back to my example. We've got Mr. and Mrs. that are the main owners of the only owners of the SPV that's got 3, 4, 5 properties within it. And it's done, they've done what they've needed to do, and they've gone into retirement, and they're living off the rental profits in retirement. And then ultimately, as will happen to all of us, both parents eventually pass away. Now, normally that SPV with the properties goes into the estate. If the kids don't want to run the company or the portfolio, then the portfolio is sold, and the proceeds of the sale go into the deceased estate, forms a pot of money that may be eligible for inheritance tax paid, and then the kids get the cash out of it. With these growth shares, when the properties are actually sold, the profit, the growth, is allocated not to the A ordinary shareholders, not even the B or the C or the D shareholders, but get allocated to whoever has the growth share. And it's a trust that owns the growth share. And I'll talk about trust a little bit more in a second. And the reason it's in a trust is that, therefore, the proceeds of the sale, remember my little example that the kids don't want to run the property empire, so the portfolio is going to get sold, then the proceeds of the sale don't go to the individuals yet, they go into a trust. The trust is run by trustees. The trustees have the beneficiaries nominated within the trust document, which is the kids, let's say. So then the trustees pay the proceeds out via the trust to the kids. So the kids get the money, but it's what it has done is bypassed and sidestepped the deceased family estate because it's gone into the trust. It's outside of the estate. Therefore, it's outside of any inheritance tax calculation. And in fact, if you think you might have heard of this before, I've talked about this a number of times on my updates, where life insurance, if it's not, should be put inside a trust. It's the same type of discretionary trust. And the reason you put life insurance in a trust is for the exact same reason, is that when it's claimed upon, when mum or dad pass away, and the life insurance is triggered as a claim and the insurance company pay out, because the life insurance is sat in a trust, the insurance company pay the proceeds to a trust, not to the deceased estate. And then the trust pay it to the beneficiaries, therefore it's sidestepped inheritance tax. Didn't want to get into insurance on this, but there's real parallels here. So that's why these SPVs are now moving into the realms of what are being described as smart companies, where there's this new category of share. Now, here's the thing. This all sounds great. Hopefully, I've explained it succinctly and you understand it. But then we've got the reality of between now and your parents passing away of still being able to refinance properties, being able to purchase properties. And what's the lender's take on this? And right now in 2024, it's such a new thing that there's a real limited appetite to lend to these smart companies. Now, don't misunderstand me. I'm not saying that lenders will not lend on smart companies. There are a number of lenders that will, but they are definitely the exception to the rule. So there's a real limited small number of lenders, which may mean, not necessarily, because within this small short list of lenders, there are some that are competitive, but there are some that will charge you a little bit of a premium. So if you've got other issues and challenges going on, we may end up going to that lender that will charge you a little bit more. But right now, there's a real limited appetite to lend to smart companies. And here's the point that when I've been speaking to lenders, as I do about these, do you know what? It's a lack of it's ignorance. It's a lack of understanding about what these smart companies are there to do. As soon as lenders quite often hear the word trust in association with a limited company, then the shutters come down. Whereas I think over time, when these things start to get momentum and the lenders are prepared to really, really understand what these smart companies are about and that there isn't really a risk to them, I think we'll find more lenders coming on board. But right now, we've got this limited appetite. So the takeaway message is don't despair. If you've already got a smart company, if you think, well, actually, it makes sense for legacy, succession planning, inheritance tax planning, for me to have one, don't be put off by what I've said. But what you must do is talk to your broker team so that you see that there are still options for you with lenders, still ways forward, so that you can still continue to refinance, still get best deals. And if you're building a property portfolio still, that's not going to be hampered. So, the devil's in the detail with this thing. And it may be over the next year or two. I don't see things changing in the real short term, but more in the midterm. I'd like to think that lenders will embrace this type of company a little bit more. So, look, if you want to understand this a little bit more than what I've just said in these last few minutes, then there'll be a link on the comments below. Click the link, book some time with the team, and they'll talk to you a little bit more about smart companies and, again, how that might impact you from a lender point of view.